Hello there, my name is Stuart Hutton. I'm the Chief Investment Officer at Simply Ethical. So today I want to talk to you about why investing little and often is so important. So here at Simply Ethical, we often spend time talking with clients about the benefits of timing the market as opposed to timing the market. We have seen so many dips and rises in the market over the past 2 decades, and even before that, all for different reasons, however, all benefiting clients. I often joke with clients that if only I had a crystal ball, I would make us all rich. Or would I? Because we must not forget, if I had one, so would everybody else. In fact, there lies the paradox. By none of us having one, we rely on being able to actually truly assess the market for what it is. So markets go up and down. The one thing we can always be certain of, alongside that and death of taxes, is we know that markets will go up and down, daily and weekly and even year to year. Now, over long term, some companies will succeed, some will fail, but actually most do okay. In that they work hard, they grow their businesses, and in general achieve higher profits. Now, in those profits, in fact, it's those profits that the shareholders most benefit from, because as the market likes to see some profitable businesses, sharing their profits and sensibly retaining some for investment means that that's where the growth often is seen. Also, cash flow is significant, as a business always needs to make sure it can pay its bills and also invest into new opportunities and equipment if it wants to grow. That is why it's Simply Ethical. We are always looking for high quality that meets our ethical and shariah compliance standards, and in fact also offer our investors a chance to see their money grow over the long term. So why not just a lump sum? Well, for some investors it's just not possible to put all your money you're going to invest at one time into the marketplace. And in fact, early in your life, you may not have that kind of money to be able to do that. And in fact, it's how you set yourself sensible goals and those to achieve towards the parts of your life which at the time you'll need the money. For example, your retirement or maybe paying university fees for children becomes so much more relevant. So for many, it's about being put together a financial plan to save and to do this on a regular basis. So why little and often? Well, the reason this often comes up in a conversation is that for most it's the only way to save. By putting aside a little each month from your earnings means that over time you're able to build up a pot of savings that can work towards your financial goals. In a recent article on the Simply Ethical website in our blog section, we demonstrated how by saving for a child from birth, if you put about £127 a month aside, you would be able to save approximately £54,000 towards maybe, say, their education by the time they're 18 years old. This is based upon a return of about 7% per year on average. However, we also worked out in that same article that if you actually delayed that start by 5 years, you would actually have to increase this to about £215 per month. Now the good news is you're still able to achieve your goals. So don't panic if you haven't started yet, but with careful planning, you can succeed. So what about when markets go up? Well, of course, one of the great benefits of investing is that seeing the growth of your savings and your investments over the long term and seeing them grow. The compound effect of investing also means that over time you will see the value increase, even where the shorter term fluctuations may see them go down. Now, the compound effect of investing is that while you're watching your capital grow, you will also receive from many of your investments an income which may come in the form of dividends or other types of returns. For some, this income is something you can use on a regular basis to help your day-to-day needs. However, for many, this income isn't needed straight away. So that's where you can reinvest it, and it's available to be invested to buy those shares back again. Now, over time, this income becomes gradually a more substantial part of your overall return. And of course, when you've received income, it can't be taken away from you again. You've got it, it's there. So even if the capital value does not grow as quickly as you may hope, by reinvesting this, it also means you're able to add to the capital value, which means in turn you'll be able to increase the amount of income being paid away. Now let's think of an example of this. So let's say you had a share that was worth £10 and it offered a dividend of 50p per share, so a yield of about 5%. Now if you reinvested that, each time the dividend was paid away per year, you're about to add to the capital value. So when the next dividend was declared, you'd actually be paid the income not just on the £10, but the £10.50, which means that you would receive actually 52.5p per share. Now, what about when the markets go down? Well, none of us like to see the markets go down, but they do go down. It's a natural cause for the markets. And in fact, quite often it's seen as a very positive thing, because often it means that those who hold on to the shares really understand their true value. Of course, when they do decline, it may be just be for 1 or 2 days. It may be for a longer period of time. The capital value of your investments may go down considerably. However, one of the great benefits to this is when investing the income, basically you can start to generate the same level of income whilst those shares have gone down. Doesn't always happen, but in general it does. It also means that when reinvesting that income, you're buying shares at a cheaper value because the share price is lower in the marketplace. So you will benefit from being able to purchase even more shares with the cash available. Now, when paying regular amounts into your investments, this works in the same way. So if you're putting £100 or £500 a month into your portfolio, when you're buying the shares going up in value, that's great. You're getting more money for your shares as they grow. But if the share value goes down, you'll be able to buy more shares. So I want to try and give you an example to help you understand how that works. So let's say you continue to invest in the shares that I mentioned earlier, and they've grown by, let's say, 50%. We've had a good few years and they've grown really well. Now, even without the income reinvested, that means the share price would have grown from £10 to £15. So that does mean you'll be able to buy, when you put your money in, only actually 2/3 the amount of shares that you were buying originally. Now, that does mean still you'll get the returns of the income, and that income can be reinvested, but given the growth you're getting, you might still be happy with that. But what if the share price went down to £7.50? Well, that means it's halved in price. That means you're seeing the value of those shares you owned at £15 be worth half the amount. However, if you then invest at that point, you will be able to buy twice as many shares. So let's kind of break this example down a bit further. If you'd bought 100 shares at £10, then 100 shares at £15 when it had grown to its value, but then it had half its value and you bought another 100 shares. It means that if you worked out the average cost of your share, it'd work out at about £10.80 per share, just a little bit over there. But what that also means is that when it goes back up to £15, you would have benefited from buying the cheaper shares. Now, as a conclusion to this, it's really important to understand that investing little and often allows you to set financial goals, measure your success over time, make sure you are on track, and not feel like you're committing all of your life savings at any one point.